Before we begin, I am Max, and if this video helps you think more clearly about your money, gently press like so it can reach someone silently struggling tonight. Subscribe if you value calm and practical financial guidance without hype, and share this with someone who needs steady direction instead of noise. Comment the number 1 if you are rebuilding your savings right now, and comment 0 if you are starting completely from scratch. Sometimes sharing a video like this is not about views or algorithms. It is about quietly helping someone avoid years of regret. I want to start by telling you something personal because I was not always disciplined with money the way I am today. A few years ago, I finally saved my first $20,000 after nearly 3 exhausting years of consistent effort. I remember staring at my bank account that night, feeling proud, validated, and convinced I had finally figured things out. Within 6 months, that $20,000 had dropped below $5,000, and I felt embarrassed even admitting it. Nothing catastrophic happened to me during that time. No medical crisis, no sudden layoff, no emergency that forced my hand. What happened instead was far more dangerous because it felt justified, reasonable, and even responsible at the time. I upgraded my car to something more respectable, telling myself it was time to look successful instead of frugal. I moved into a nicer apartment because I believed I deserved a better environment after years of sacrifice. I even booked a vacation to celebrate my progress, convincing myself that you cannot take money with you when you die. The hard part was not saving the $20,000. The hard part was protecting it from myself. The most dangerous moment in your financial life is not when you are broke. It is when you finally feel stable. The first 48 hours after hitting a savings milestone is when your brain starts whispering that you earned an upgrade. Your brain craves certainty and immediate reward, but wealth building demands patience and emotional restraint over decades. That internal conflict between reward and restraint determines whether $20,000 becomes $350,000 or returns to zero. I learned that saving money requires discipline, but growing money requires psychological strength that most people never train. So today I want to walk you step by step through exactly what I would do now if I had $20,000 saved again. The very first question I would ask myself is simple. Do I have any debt charging more than 7% interest right now? If the answer is yes, I would immediately pause every investing plan and focus on eliminating that debt completely. According to recent Federal Reserve data, average credit card interest rates are now sitting around 21%. That means if I carry a $10,000 balance at 21%, I am losing money every single day. Many people try to invest while carrying high interest debt, thinking they are being productive and forward-thinking. I once did the same thing because I believed starting early in the market was more important than cleaning up debt. But paying 21% guaranteed interest while hoping to earn 9 or 10% in the market makes no mathematical sense. The stock market historically averages around 9 to 10% annually over long periods, but that return is not guaranteed. Credit card interest, however, is guaranteed, and it compounds against me every single month without mercy. If I owe $10,000 at 21% and only make minimum payments, I could spend decades paying it off. Over that time, I might pay more in interest than the original amount I borrowed, which is financially devastating. When I was younger, I invested $10,000 into index funds while still carrying high interest card debt. 3 years later, the market was up nearly 30%. And I felt proud seeing my investment grow to $13,000. What I ignored was the $8,000 in interest I paid on my credit card during that same period. My $3,000 gain cost me $8,000 to achieve, which meant I was actually $5,000 poorer. That painful realization taught me that eliminating high interest debt is a guaranteed return on my money. A guaranteed 21% return by paying off debt will always beat a potential 10% return in the market. So my rule is simple and firm. Anything above 7% interest gets paid off before I invest a single dollar. That includes credit cards, personal loans, and sometimes even certain private student loans depending on their rates. Once that high interest debt is gone, I am no longer bleeding money silently while trying to build wealth. After eliminating high interest debt, the next step I focus on is building a proper emergency fund before investing aggressively. Most people skip this step because it feels boring and unproductive compared to investing in the stock market. But I learned that an emergency fund is not about growth. It is about protection and emotional stability. If I am single, renting, and have a stable job, I aim for at least 3 months of essential expenses. If I have a mortgage, children, or variable freelance income, I increase that target to 6 months minimum. For many Americans, that number ranges somewhere between $8,000 and $25,000. According to recent surveys, nearly 40% of Americans would struggle to cover a $400 emergency. That statistic alone tells me most people are living one unexpected bill away from financial stress. I used to think an emergency fund was wasted money sitting there, doing nothing productive. Then my car transmission failed, and the repair bill was $1,200 I had not planned for. At that time, my money was fully invested and I faced three terrible choices all at once. I could sell investments and risk taxes or losses, put the repair on a high-interest credit card, or delay fixing it. None of those options were strategic decisions. They were panic-driven reactions to a preventable situation. That experience showed me that an emergency fund buys something more valuable than returns. It buys peace of mind. Peace of mind allows me to stay invested during market downturns without being forced to sell at the worst time. If the market drops 30% and I lose my job at the same time, my emergency fund protects me. Without that buffer, I would be selling assets in fear, locking in losses that might have recovered. So I keep my emergency fund in a high-yield savings account, earning around 4 to 5% today. It is not exciting, but it is FDIC insured and stable, which is exactly what emergency money should be. Once my debt is gone and my emergency fund is fully built, only then do I move into true wealth-building mode. The first wealth-building move I make after securing my foundation is maximizing a Roth IRA contribution. A Roth IRA is powerful because the money grows tax-free forever. Not tax-deferred, but completely tax-free. That means every dollar of growth inside that account belongs to me without future tax penalties. Contribution limits adjust with inflation, and recently they have been around $7,000 annually for those under 50. If I qualify based on income limits, I contribute the full allowed amount as early in the year as possible. So let me show you why this matters in practical terms instead of abstract financial theory. If I invest $7,000 at an average 9% return for 40 years, it compounds dramatically. Over 4 decades, that single contribution could grow into hundreds of thousands of dollars without additional taxes. In a taxable brokerage account, I would owe capital gains taxes on that growth when I sell. In a Roth IRA, I keep the entire tree, not just the seed I planted decades earlier. When I first opened my Roth IRA, I felt overwhelmed staring at the blank investment options. I remember thinking I needed to research individual companies and pick the next breakthrough stock. That mindset almost led me into unnecessary complexity and risky speculation. Instead, I chose a broad total market index fund with a very low expense ratio. Funds like VTI or VOO track large segments of the American stock market efficiently. Their expense ratios are often around 0.03%, which keeps costs incredibly low. Lower fees mean more of my money stays invested in compounds instead of being eaten by management costs. Historically, the S&P 500 has delivered close to 9 to 10% average annual returns over long periods. That does not mean it rises every year, but over decades, it has rewarded patient investors. My job is not to outsmart the market. My job is simply to participate consistently and avoid interfering. Let me explain what compound growth actually does in real-life numbers instead of just abstract percentages. If I invest $20,000 today at an average 9% annual return, time becomes my greatest ally. After 10 years, that $20,000 could grow to roughly $47,000 without additional contributions. After 20 years, it may grow beyond $100,000 simply because I stayed invested. After 30 years, that same $20,000 could approach $300,000 or more. That means one disciplined decision today can multiply nearly 15 times over 3 decades. Now imagine I add $500 every month on top of that initial investment. Over 30 years at similar returns, that steady contribution could grow into well over $1 million. The majority of that final balance would not be money I deposited. It would be growth generated by time. That is the quiet power of compounding, where patience produces results that effort alone cannot. Here is something even more important. Delaying this decision is extremely expensive in invisible ways. If I wait 5 years before investing that same $20,000, I lose 5 years of exponential growth. Those 5 years could reduce my ending balance by well over $100,000. That is not just money disappearing. That represents additional years I might have to work later in life. When I was younger, I underestimated how powerful early action could be over long time horizons. Procrastination does not look dangerous in the moment, but its cost compounds silently over decades. If I tell myself I will start investing next year, that delay might cost me several years of freedom later. Time in the market has historically proven far more powerful than attempting to time the market perfectly. The market spends much of its history near all-time highs because economic growth trends upward over time. Waiting for the perfect crash often means sitting on the sidelines while long-term growth continues without me. One of the most expensive mistakes I almost made was believing I could wait patiently for the perfect time to invest. I remember staring at market charts near all-time highs and convincing myself a major crash had to be coming soon. The reality is that markets spend a significant amount of time at or near record highs because economies tend to grow. Innovation, population growth, productivity gains, and corporate profits naturally push markets upward over extended periods of time. If I only invested when the market was not near highs, I would likely spend most of my life sitting in cash. There was a widely cited study examining the worst possible market timer over several decades of historical data. This investor consistently invested right before major crashes, including some of the worst downturns in modern financial history. Despite consistently terrible timing, that investor still built substantial long-term wealth by simply remaining invested afterward. Meanwhile, the cautious person waiting for clarity often ended up with minimal gains because they never committed fully. That lesson changed my mindset because it showed me that patience outweighs precision in long-term investing. Research from major financial institutions shows that missing just the 10 best market days can severely damage overall returns. What makes this even more dangerous is that many of those best days occur immediately after sharp declines. When fear peaks and headlines scream panic, that is often when powerful recoveries quietly begin. If I step aside during fear-driven volatility, I risk missing the rebound that repairs previous losses. I briefly experimented with short-term trading because it seemed exciting and intellectually superior to passive investing. However, data consistently shows that most active traders underperform simple broad index funds over long periods. Many individual traders actually lose money despite the broader market generally trending upward over decades. That realization forced me to accept that complexity and constant action do not automatically produce better financial outcomes. In fact, strategic inaction often outperforms emotional reaction when markets fluctuate unpredictably. From that point forward, I committed to disciplined, systematic, and deliberately boring long-term investing practices. The next trap I had to confront was something far more subtle than debt or market timing, and that was lifestyle inflation. Lifestyle inflation happens when my spending rises simply because my savings or income improves temporarily. When I first reached $20,000 saved, I felt like I had unlocked a new level of adulthood. That emotional high made me believe upgrading my life was a natural and deserved next step. I told myself I was not being reckless. I was simply aligning my lifestyle with my new financial identity. The first upgrade was my car, which had been reliable but modest for several years. I traded it in for a newer model with a $400 monthly payment that felt manageable. $400 per month did not feel dangerous in isolation, especially compared to my total income. What I failed to calculate was what that $400 could become over 30 years of investing. If I had invested that same $400 monthly at 9% for 3 decades, it could grow dramatically. Over 30 years, that consistent contribution might approach $800,000 to $900,000. That means I effectively traded a slightly newer car for close to $1 million in potential retirement wealth. The hardest part is that after just a few years, the excitement of the new car completely faded. Psychologists call this hedonic adaptation, where we quickly adjust to improvements and return to baseline satisfaction. Once I adapted to that upgrade, I began looking at even newer models as if I deserved another step forward. Lifestyle inflation rarely happens in one dramatic purchase. It usually unfolds through small, justified decisions. A nicer apartment that costs $400 more per month can quietly erode long-term wealth. That additional $400 invested monthly over 30 years could exceed $900,000. When I compare temporary comfort to nearly $1 million of financial independence, the math becomes painfully clear. Every upgrade carries an invisible retirement cost that most people never pause long enough to calculate. Recent economic data shows that the personal savings rate in the United States has fallen dramatically compared to previous decades. Many households are now saving only a small percentage of their income, often less than 4% annually. That means the average American may only be setting aside a few $100s per month at best. A few $100s per month feels harmless to spend, but over decades it represents enormous lost opportunity. If I invest just $250 per month at 9% for 30 years, it compounds substantially. Over 3 decades, that seemingly small monthly investment could grow to well over $500,000. Yet many people consistently choose short-term consumption over long-term compounding without fully understanding the trade-off. The choice often looks like a slightly nicer lifestyle today versus significant financial freedom decades from now. When I reframed spending decisions as future freedom decisions, my perspective shifted dramatically. Every dollar I choose not to invest today is a dollar that will never compound for my future self. Once I internalized that idea, lifestyle upgrades no longer felt harmless or purely cosmetic. They began to look like small withdrawals from my long-term independence. Strategy also changes depending on how old I am and how much time I have to recover from volatility. In my 20s, time is my greatest asset because I can withstand market swings without immediate consequences. At that stage, I would consider allocating around 90% to stocks and 10% to bonds. With decades ahead, temporary market crashes become opportunities rather than threats to my future plans. If markets drop 40% while I am young, I can continue investing and benefit from lower prices. In my 30s, responsibilities often increase with mortgages, children, and career transitions. At that stage, I would likely shift toward an 80% stock and 20% bond allocation. I would also expand my emergency fund to 6 months of essential expenses to protect my family's stability. In my 40s, the conversation becomes more urgent because my time horizon before retirement starts shrinking noticeably. At that stage, I would evaluate whether I have saved at least 4 to 5 times my annual income. If I am behind on that target, $20,000 becomes significantly more important than it did in my 20s. I would prioritize maximizing retirement accounts and consider catch-up contributions if I qualify by age. My asset allocation might gradually shift closer to 60% stocks and 40% bonds for stability. The reason for that shift is not that stocks suddenly become dangerous, but that my recovery window becomes shorter. A 25-year-old can recover from a major market crash over decades without changing retirement plans. A 55-year-old does not have that same luxury of time to rebuild after a severe downturn. Asset allocation is less about fear and more about aligning investment risk with realistic time horizons. Understanding time horizon helped me stop copying strategies from people in completely different life stages. Sometimes the best investment I can make is not in the stock market, but in increasing my earning capacity. If a certification or skill upgrade can raise my income by $10,000 or $20,000 annually, that return is powerful. Spending $1,000 to gain a skill that increases lifetime income can outperform many traditional investments. However, I only pursue skills that have clear demand in the labor market, not vague promises of opportunity. Investing in myself works best when it connects directly to measurable income growth rather than abstract motivation. So once debt is gone, my emergency fund is built, and retirement accounts are funded, I consider strategic skill investments. But I never use self-investment as an excuse to avoid disciplined, long-term investing. At this point, I simplify everything into a repeatable system that does not require constant decision-making. I automate monthly contributions into broad index funds so my wealth grows quietly in the background. Automation removes emotion from the process and prevents me from sabotaging myself during market volatility. When I look back at the version of myself who first saved at $20,000, I do not see a financial expert. I see someone standing at a crossroads between discipline and ego, between patience and short-term validation. $20,000 is not just money, it is a test of identity and long-term character. It asks whether I am willing to be consistent for decades while others chase excitement and instant rewards. Wealth is rarely built through brilliance or secret knowledge. It is built through repetition and emotional control. The people who succeed are not necessarily smarter. They are simply more comfortable being boring. They keep buying index funds when markets fall, when headlines scream, and when others panic. They drive paid-off cars while coworkers finance luxury vehicles to signal success. They ignore social pressure and focus on compounding quietly in the background for 30 years. That is the real difference between turning $20,000 into $350,000 or burning it away. It is not luck, income level, or timing. It is the ability to follow a simple plan without distraction. If this message resonates with you, share this video with someone you know who is at that same crossroads. You might help them avoid years of unnecessary stress and give them clarity at a moment that truly matters. Sometimes a single disciplined decision can change the trajectory of someone's financial life for decades. I am Max, and if you are ready to choose patience over impulse, start today and let time work quietly in your favor.